Well, most Asian markets, they have opened up in the red. Investors are a tad bit worried about trade relations between the United States and China, and also global concerns over spiking oil prices overnight. Now, it's going to be a data-heavy week for China as October retail sales, industrial production, jobless rate, and money supply, they are all due this week. That'll be a major indicator of the Chinese economy. For starters, the Nikkei that was down close to around 50-80 points odd, that's recovered from the low point of the day, primarily because the dollar-yen has now moved to around 114 odd mark. Now, that's good news for an export-oriented economy, so keep an eye out on that one. If you get an intraday chart of the Nikkei, you'll see that one has recovered from the low point of the day. But if you're looking at the other markets, well, the Kospi, the first tick was in the red. That's sitting with a cutoff around 0.3%. So let's get that market up. And even the other couple of markets, they're opened up with a bit of a negative bias just to kickstart trade. The Taiwanese index, well, holding more or less flattish. But for starters, the SGX Nifty seems to be taking note of what's going on with Brent crude prices. That's moved up a tad bit, closer towards $71 per barrel. Remember, Friday night, it even breached $70 per barrel. So maybe a bit of a red tick just to kickstart trade on the Nifty.
Okay, and it was a red tick in US as well because the Wall Street ended lower on Friday on concerns of global economic slowdown due to high oil prices. Now, Dow ended lower by around 200 points, while the Nasdaq underperformed because that one ended down about 2%, and the S&P 500 also saw cuts of around 0.9%. The equities, however, recorded gains for the week following a big post-midterm election rally. CNBC's Josh Lipton gets us a wrap of all the action on Wall Street.
U.S. stocks finishing the day lower, though still higher on the week. The Dow falling 201 points, the S&P off by 25, and the Nasdaq down 123. Oil prices down for the 10th consecutive day, sinking deeper into bear market territory. Crude has now wiped out its gains for the year. The 10-day decline is the longest streak on record for oil prices in the U.S. since 1984. Crude futures are also poised for their fifth straight week of losses. Meanwhile, the Fed unveiling a report on the health of the banking system for the first time, saying that the safety and soundness of large institutions is improving. The report did add, though, that risk management problems continue to affect some of the firms, with 43% of bank holding firms receiving a, quote, less than satisfactory rating. E-cigarette maker Juul will halt sales of its fruity-flavored nicotine pods from retail stores. The news comes ahead of an expected announcement next week from the Food and Drug Administration that will restrict the sales of flavored e-cigarette cartridges to try and curb the teen vaping epidemic in the U.S. That's the action from the U.S. market. Now back to you in Mumbai.
Well, moving on, let's hear out some global voices on the road ahead for the U.S. markets post those midterm elections, as well as the Fed's rate trajectory going ahead.
I don't think long-term investors should suddenly, oh my God, think about getting out of the market. I just see some struggles with the higher interest rates, with expectations of earnings are going down week by week. We see cuts of 2019 earnings estimates. There may be a rotation going around. We know we've commented on the weakness of NASDAQ. It's too early. NASDAQ's still up more than any of the other major indices year to date, but certainly that gap, which was so big in the summer, has certainly narrowed. So again, long-term investors, sit pat. Good values are out there. Short-term investors, there's going to be a lot of trading in and out, and a lot of choppiness, I think.
Some measures buybacks are going to be about 800 or 900 billion this year, so it is still a very big number. It's going to add probably 3 or 4 percentage points to earnings growth. So it's certainly not something that should be underestimated. But I think, we've had this big earnings boom this year. Third quarter actually ended up, I think, surpassing everyone's expectations. There's not a lot not to like about the stock market, but there's a lot of variables in there because earnings growth could surprise to the downside. The Fed could surprise to the upside. And then that's a whole different story. So we really don't know how the next chapter of this book is going to be written.
Post-midterms, you generally get about a 10% rally in the Q4 following the midterm election. That being said, we know there's things going on with rates going up and trade concerns, so maybe that historical average isn't going to hold, but we do think in the next 12 months the market is moving higher. I think you would just have to see sentiment change. We always come back to sentiment. Investor sentiment is just okay. People don't feel that good, even though the data is really strong.
Fed on Thursday, by saying nothing, actually said it all. I mean, if they have any thought of pausing in December, they would begin to make noises now. They made no such noises. Another quarter-point increase into a situation, potential trade disruptions, slowing economy. Most estimates are under 3% for this quarter. Rising yields, I think, are the biggest immediate threat that the market has to contend with.
I think what the Fed is saying is that we're at 2%, neutral is at 3%, so we have to go at least to 3% because we're hitting both on our full employment mandate and our inflation mandate. So there's really no justification or reason to be below neutral, which I think most people think is around 3%. And I think the Fed has pointed out that inflation can run a little hot north of its 2% target, and that's okay. But I think what the Fed is really looking at, and what I'm really looking at, is the inflation expectations. Inflation expectations are even more important than where the actual inflation data are running right now relative to the Fed's target.
All right, turning our attention to the European markets, they ended more or less in the red. You had the DAX that was relative outperformer because that ended more or less flattish. Investors, they were reacting to the Federal Reserve's comments. They also monitored all the political sentiments that are coming out there in the continent. So the FTSE as well as the CAC, both of them were down. The DAX ended more or less flattish. But if you're looking, at a particular data point that the market was focusing on, they were focusing on the key Brexit meetings. That was scheduled over the weekend. Shifting focus to peripheral Europe, though, most of those indices, they ended in the red. So the Irish, the IBEX, as well as the Italian index, all of them were down between 0.5% to close to around 1% odd. And even if you're looking at the emerging markets, the Russian market had a rather rocky ride. That was down 3% in Friday's trading session.
Okay, let's shift focus now to the world of commodities because the crude oil price is in focus as the OPEC meeting in Abu Dhabi is in spotlight to see if real production cuts will be made. Brent crude is higher by 1%, whereas NYMEX also gains around 0.8%. Remember, US crude has posted the longest losing streak in over 34 years, falling for 10 consecutive sessions. But now Brent is back at that $71 per barrel mark from the $69 per barrel that we had seen earlier last week.
Well, in the currency space, the dollar index, that's strengthened. That's hovering near a near 16-month high. So keep an eye out on that one, moving towards the 97-odd mark. This has Fed affirms its monetary tightening stance. Meanwhile, the yen has moved all the way to around 114-odd to the dollar. So keep an eye out on that one as well.
Okay, it's time now for a quick break on the show. Up next, we'll get you all the cues and news you need to know for trade this Monday morning. Stay tuned.